Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Welcome to the Global View on this Monday. Well, let's get across what's going on at a macro level. US annual inflation slowed considerably in June, reinforcing the view that the Federal Reserve's aggressive monetary tightening cycle may be at an end. The personal consumption expenditures price index increasing just 0.2% last month to be up 3% for the year, the smallest annual gain since March 2021. And consumer spending, which accounts for more than 2/3 of US economic activity, increased 0.5% in June, in line with forecasts. Well, US Treasury yields weakened on evidence of slowing inflation. US yields had earlier benefited from a move by the Bank of Japan to allow the country's interest rates to rise more freely in line with increasing inflation and economic growth. The US 2-year falling to 4.89% and the 10-year down to 3.97%. And the Japanese yen had its most volatile trading session in months on Friday after the Bank of Japan tweaked its yield curve control policy. The US dollar fell against most major currencies, and the Aussie, well, that fell almost 1% to, well, it's around 66.5 US cents. All right, we're just taking a look at the personal consumption expenditure index out of the States. Let's see if we got that. So there we can see just where it's tracking, which is obviously in a positive direction in downward there, which is good news. Obviously, that's what the Reserve Bank, America's central bank wants to see, just in relation to the Fed's moves in response to its aggressive tightening. Well, let's get across what we're seeing there, and more broadly, globally. John Noonan joining us from Thomson Reuters. John, very good to catch up with you on this Monday morning.
Yep.
So, yeah, what was your view just as far as that latest inflation read is concerned out of the States?
Just what the doctor ordered for risk investors. It didn't miss expectations by much, but it was lower than expectations. And the closely watched core annual PCE was actually slightly below expectations. So that's what the market's looking for. If you look at the market pricing now, they're pricing in roughly a 30% chance, only a 30% chance that the Fed will hike one more time. So basically, they're pricing in the fact that the rates have peaked, small chance it may go another 25 basis points. I think the market wouldn't be too upset if that happened. They would probably see that as the Fed taking out insurance, and more likely will be followed up with a rate cut or take that insurance away if the inflation picture remains fairly benign. So it's what the market wanted. Of course, we've got the job numbers this week, the U.S. non-farm payrolls on Friday. And, if that follows up with a really Goldilocks number where jobs remain, the job market remains relatively strong, but we don't see wage rise components in that jobs report show any kind of rise, or unemployment starts to tick up slightly, that would be good. I suppose the worst news for market is if that's a really strong number, and it shows that the labor market is still extremely tight. But the market's in a very good mood now. The VIX index had its lowest weekly close in over 3 years. So but the market's feeling quite good.
Yeah, John, you mentioned that Goldilocks zone the US appears to be in, with that resilience in the jobs market, with inflation coming off. So that ticks those boxes. Is that part of the reason why we're seeing those rally in risk assets at the moment? You don't have to look at what's going on more broadly, I guess, on the stock market there.
Absolutely. So if you take Japan out of it, the Bank of Japan caused some confusion on Friday, and that created some volatility, which the market doesn't really like volatility. But if you look at the other central bank moves last week, both the Fed and the ECB, they're both saying we're very data dependent. And the ECB was a little bit surprising to many by not tipping that there's more tightening to come. More tightening may come depending on the data. But they also hinted very strongly, Christine Lagarde, ECB president, hinted that that could be it. And so that's what the market's been waiting for, and that's what they want to see. So, yes, it's good for all risk assets across the board. The other driver earlier last week was China optimism, but that faded a little bit. And the one commodity that didn't do so well on Friday or Thursday and Friday was iron ore. Iron ore came off quite a bit because that sort of optimism that was bred out of the fact that there's more stimulus to come from China. It just keeps getting delayed, and there's some skepticism whether or not they're going to make a serious enough or strong enough move to provide stimulus. So that's one to watch. There is, I have seen a report this morning saying that there's going to be a news conference at 3 p.m. Beijing time today, where they're going to announce more stimulus to help consumption in China. So that will be closely watched. We'll see if that's going to be something significant or another piecemeal dribs and drabs slow feed that tends to disappoint. But so those are the factors that are driving commodities and risk assets in general.
Yeah, certainly with commodities, John, we have seen those prices appreciate since that news that China was considering more stimulus, albeit incrementally. And you only have to look at what happened with oil recently too, which is managing to, I guess, gain on speculation of greater demand, particularly out of China, but also combined with those production cuts.
That's right. And also, too, I think the market was overly pessimistic about China and probably overdid a little bit. The short China trade probably became a little bit too crowded. And similar story with oil. The oil market was extremely bearish, and sentiment probably turned a little bit too bearish. And then we saw the supply cuts, coming out of OPEC, and that was one of the triggers. And also hopes that China will do something is one of the other triggers. So I think right now we're sort of not really sure how this is going to play out. Is this short covering due to the fact that things aren't as bad, or maybe the market was too bearish and got too crowded? Or is there true reasons to be optimistic that China is going to take steps, and this miserable recovery they've made post-COVID will start to pick up, and will start to encourage everybody. So I think the jury's out. I think for sure yet. We'll see what happens later today out of Beijing. But it's something to keep an eye on. And now that the markets are getting quite calm about central bank expectations, the fact that rates are peaking, so the China play will become quite a bit more important.
John, let's stay in that part of the world. You mentioned that move by the Bank of Japan, loosening its yield curve control settings. Interesting, the market reaction there. How would you describe that, and what does it actually mean going forward, do you think?
Yeah, well, that's the big question, isn't it, Andrew? I mean, it was quite a volatile reaction. We saw the yen strengthen quite a bit, and then we saw it into the end of Friday. During the U.S. session, it weakened a lot, and the range on the day was 2.4% or something, which is quite a big range. So here's the question I think everybody's asking. Was this move by the Bank of Japan the beginning of a tightening cycle? Is the next move going to be to start to increase or take away stimulus? Or was this just a technical adjustment to help them better manage the yield curve control? So, the first reaction, obviously, when the yen strengthened, was that this is the beginning, and this is what we were hearing from a lot of clients, that this is the beginning of the Bank of Japan ending this 2-decade-long ultra easy monetary policy. But then later in the day, there was thinking of, well, maybe this was just a technical adjustment to help better manage their yield curve control. One of the things the Bank of Japan does have to worry about, though, is their credibility. They were a bit opaque in their messaging. And, they've got this enormous public debt in Japan that's managed through controlling the JGB market. So their ability to control that market is based a lot on their credibility. So there was, some reports saying that there was some yen selling because they felt their credibility was damaged a bit. So the Bank of Japan is going to be very closely watched right now. And the market is still trying to determine what that meant on what they did on Friday is this the start of a tightening cycle, or are they just messing around the edges? So it's going to be very interesting, and watch the space.
Yeah, absolutely. John, let's just return to the States. Of course, we are in the midst of earnings season there. What are you seeing? Largely positive, and of course the focus has been particularly on mega cap tech.
Yes, that's absolutely right. Largely positive. It just shows the U.S. economy is still extremely resilient. There is some signs that there's some deterioration in some of the consumer spending, but you never can underestimate just how strong the consumer is in the United States, and how resilient that is. So the numbers are pretty strong, and the unlikely scenario that despite the Fed tightening, that there would be a soft landing, is suggesting that between the earnings reports and the data that we're seeing coming through, and the resiliency shown through all the numbers, particularly in the labor market, that maybe that very little narrow runway that the Fed was hoping that they could land on is going to happen. And while that is the case, while that view holds, the U.S. market remains strong. And one of the things that I think that it's very difficult to get bearish or try and pick a top in U.S. equities or equities in general is that most of this rally has been a despised rally. I mean, there's been a lot of bears out there, very skeptical about what this rising market, and that this tops was going to be in place very soon. We've seen a few false breaks down to the bottom. So we haven't reached that stage where the market is very optimistic or euphoric. There's still a bit of skepticism. So we're not there yet, but at some point the market will get overly bullish and see no downside risks and shoot ahead, and that's when we start to get nervous. I don't think we're there yet.
John, great to get across what's moving markets at the moment. Thanks for joining us on Thomson Reuters. Have a great week.
Thanks for having me, Andrew. You too. Have a great week.
All right, so just a check of where we're likely to open. SPI futures indicator is going to be positive there, as you can see, and that was off the back of a positive session we saw on global equity markets on Friday. That is the global view. Stay with us. The open is just moments away.